Dad. Irma is killing me.
There are a lot of things that you have to take into account as you age into retirement, or even if you're already in retirement. But what we're going to talk about today is one of the most important, and it can be one of the most confusing, but you have to understand it. Because if you get additional income, you take an extra withdrawal from that pre-tax IRA. So it's a taxable distribution, or you sell some stock and you have, an additional capital gain that you didn't anticipate, or that pushes you over a threshold. Or you have part-time work, or some full-time work, some compensation that pushes you over a threshold. It could cost you dearly. But I don't want that to happen to you, because you want to preserve as much capital as you can so that you can increase the longevity of your retirement assets, your retirement portfolio. But you have to understand how taxable distributions could impact you for the worst. So what are we talking about today? And how can a $500 distribution, taxable distribution from your pre-tax IRA cost you a couple of $1,000s? Well, we're talking about IRMAA. And what is IRMAA? So maybe you've heard of IRMAA, or the IRMAA cliff. IRMAA stands for the Income-Related Monthly Adjustment Amount. And all that is it's a surcharge, an additional fee that you have to pay into Medicare if your income is above certain thresholds. And it's for Part B and it's for Part D. Now, if you're on Medicare Advantage, you can't get away from this. You still have to pay this IRMAA surcharge. And this is how, if you are making too much money, if you move past, above one of those thresholds, then you're going to have to pay that surcharge for for that entire year. You're going to have to pay that additional cost. So what are those thresholds? And you have to understand this, even if you're not in Medicare right now, because Medicare looks back 2 years to look at your tax returns to see if IRMAA is going to apply for this year or not. Looks back 2 years, so you have to plan for this. Because it's 2 years later now, you're looking back, you're like, well, if I would have just changed one thing, then I would not have been subject to this additional surcharge, which is going to cost me for the entire year. All right, so we got to plan for it. Here are the thresholds, and you'll see that it's focused on the income number, which is modified adjusted gross income. So what is that? Well, it's your adjusted gross income. That would be on the 2022 1040 on that front page. It'd be line 10, I believe. That's adjusted gross income plus any tax exempt interest that you receive. So muni bond interest, you would add that back. And that would get you to modified adjusted gross income. So you'll see this table is broken into filing statuses. So single, married filing jointly, and married filing separate. To the right over here, you'll see Part B and Part D monthly premiums. And these premiums, Part B and Part D, are what is subject to the IRMAA surcharge. We'll focus on Part B and Part D and married filing jointly. So if your income is below $194,000, married filing jointly, then you're not going to have an IRMAA surcharge. You're just going to pay that Part B monthly premium to Medicare, which is $164.90. All right, for Part D, you're not going to have a surcharge. You're just going to pay whatever that plan is charging you for the monthly premium. All good. That's fine. It's when you go above that income level, so you move from under $194,000 to greater than $194,000, and now you're in this category, this range, and now you got to pay a premium of IRMAA surcharge. You'll see now your Part B monthly premium jumped from $165 or so to $230. So that's an increase. That IRMAA surcharge is about $65. $65 per Part B, and that's for each beneficiary. So you and your spouse are both paying an extra $65 per month in that IRMAA surcharge. For Part D, you and your spouse are each paying an additional $12.20 to Medicare in that IRMAA surcharge. So you'll see as your income gets greater and greater, your costs for Medicare, the Medicare premiums that is, get more expensive. You may say, oh, Medicare Advantage, I don't have to worry about it. Nope, Medicare Advantage, you absolutely still have to worry about that because you're still paying your Part B premium. You may not be paying a premium to the Advantage plan, but you're still paying a premium to Medicare. So you still have to worry about this. And even if you're not on Medicare yet, because the Medicare and Social Security Administration looks back 2 years to see what your income was to determine whether or not IRMAA is going to apply this year, you got to be thinking ahead. You have to think ahead. Let's look at an example. Ebony and James, look at that beautiful, beautiful couple. They're both age 65, look great, or age 68. They look great for 68. Great, great, great. Their modified adjusted gross income, it's about $193,000. It's $193,700. They decide, it's December, they decide to take out $500 from one of their pre-tax IRAs. So now they have an additional $500 of taxable income, and they, want to do something for the grandkids or want to do something for themselves. They want to do something special, so they take that out because it's just $500. What harm could it do? So now their modified adjusted gross income is $194,200. If they had taken it from a Roth IRA, it wouldn't have been a taxable distribution. If they would have taken it from some cash that they had, it wouldn't have been a taxable distribution. But they decided to take it from the pre-tax IRA, and now it is a taxable distribution. It is included in their modified adjusted gross income. And you'll see, they just crossed that $194,000 threshold. Look, now they were here. They were here in the lowest bracket, the lowest range. They didn't have an IRMAA surcharge, but now they're in that second line. Now their income is over $194,000. So now they got to pay that IRMAA surcharge. They got to pay that extra $65.90 per beneficiary. They have to pay the additional $12.20 per beneficiary per month. So what do those numbers actually look like? Well, look, Ebony and James, they both got to pay, right? They got to pay the base Part B premium, but now they got to pay the IRMAA surcharge, the additional premium, $65.90 each. That's about $132 per month that they have to pay because of the IRMAA surcharge, because they just crossed, just barely, but crossed that $194,000 bracket. Part D, now they got to pay an additional $12.20 each. That's $24 per month in additional premiums for Part D. So now they're paying $164 total per month in Part D and Part B premiums because their income is higher. So they took $500 from that IRA, but now they got to pay an additional $164 per month for the year. And how much is that going to cost them for the year? It's going to cost them almost $1,900. Almost $1,900 for the year. That is a lot. Because they only took out $500. And we're not even into the taxes, the actual taxes on that $500. So the total cost of $500 withdrawal from that pre-tax IRA. And it doesn't have to be just from the IRA. Maybe they got sold some stock and had a capital gains that just pushed them barely over the limit. Or maybe they had some compensation, some part-time, some project work that just pushed them over the limit. Well, now they have to pay for it. And how much do they have to pay? Well, that $1,874 plus, let's say, 22% or so. Let's just say 22% federal income taxes on that $500. That's $110. Now they're out $1,900, almost $2,000. And if they live in a state that has state income tax, then they'd have state income tax on that as well. So they took off $500, and now, because of IRMAA, they got to pay over $2,000 for that year, just for that $500 withdrawal from the IRA. Painful. I don't want that for you. So what do you do about it? Well, you gotta first understand how IRMAA works. If it takes replaying this video and watching it a couple of times to really have it baked in, to really understand, or finding some additional resources, you have to understand how IRMAA works, or else you're going to pay for it. Second, keep track of your income throughout the year, right? Are you close to the ranges? And like I said, Social Security or Medicare looks back 2 years, right? So here in 2023, we don't know what the range is going to be in 2025, but those ranges typically do trend up. They get a little higher, so you have a little bit of leeway. But what the ranges are today, that's a good guide, right? That's a good benchmark. So if you're trending close to those ranges, then consider delaying any income or any distributions from retirement accounts. If you're in a role, if you're doing some part-time work or some project work, when you can delay the work or the income until next year because you're close to the ranges, do that. If you're thinking about selling some stock and it's going to generate capital gains, don't let the tax situation dictate whether it's a good or a sales decision or not, but be cognizant of the fact that if you do sell that stock in a taxable account and there are some gains in there, they may push you over the limit. So, because that's included, those gains are included in your modified adjusted gross income. So be cognizant of that and think through whether you want to make that sale today. And if you do want to make that sale, it's fine. If it's a good investment sale, if it's a good investment decision, then just make the sale. But what you could also do in your taxable investment portfolio is see if you can use any losses in the portfolio to offset those gains. Right. Now, just as a reminder, in the tax code, yes, capital losses can be used to offset capital gains, right? But capital losses can only offset up to $3,000 of your ordinary income, right? So you can also use losses to reduce your modified adjusted gross income up to $3,000. That's something that you can do as well. Itemized deductions, those types of, that does not help. Those are below the line. They do not impact your modified adjusted gross income, so that will not help. The most important thing that you can do is be aware of how IRMAA works, how your income is trending, and then if you find yourself and you're subject to IRMAA, you can always, there's an appeal process, right? There is a Social Security form that you can fill out. It's really a Medicare form that you can fill out to have the IRMAA removed. Maybe it's approved. There are a couple of conditions, a couple scenarios in which your appeal would be successful. It can't hurt. That's what I tell folks all the time. It can't hurt to submit that for appeal so you can have the IRMAA removed. What's the worst thing that could happen? And that form is the SSA 44 form. There are a couple of conditions you can submit for appeal. But above all else, just understand how Medicare works, because if not, it could cost you and cost you dearly. And I don't want that for you. I don't. Because you only get one chance at a successful retirement. Choose wisely.
I got it. That makes sense, Dad.